Good morning, everybody. Welcome to today's 1 Million by 1 Million Strategy Roundtable for Entrepreneurs. 1 Million by 1 Million, as you know, is the first global virtual accelerator in the world. Our mission is to help 1 million entrepreneurs reach $1 million and beyond in annual revenue, build $1 trillion in global GDP and 10 million jobs. And in support of that mission, we do these free mentoring roundtables as one of the elements of our offering. And we've been doing this for a long, long time. This is our 321st session. We've had over 50,000 people participate in these sessions over the years. It has been going on for many years. Started in the fall of 2008. So we've talked to a lot of entrepreneurs over the years, and it's been a real pleasure learning about what you're doing and being a part of your journeys. This event is being recorded. You will have the recording available on our blog as well as on our YouTube channel. If you are live tweeting the show today, please use hashtag 1M1M, and you can join us on Twitter at 1M by 1M and at Shromana. Both of those are channels through which we publish a lot of rich, educational, inspirational, informational content. And our YouTube channel is 1M1M Roundtables. That's where all the recordings of all prior sessions are available. It's also an interesting and intense body of learning material that you can access for free. These are the call-in instructions for this session. This is a roundtable, so we would like you to participate as much as possible. We're not quite ready for call-ins, but I will open up the line and put the slide back up when we are ready for call-ins. We are going to start today by speaking with Jon Ellis, founder of Investorist. I did Jon's story for the Entrepreneur Journeys series. I don't know if some of you may have read it already. Investorist is an Australian company, and it's a very interesting story that I wanted to showcase for you and invite Jon to introduce him to you so that you can learn from his journey. Welcome, Jon. It's great to have you here.
Thank you, Shromana. It's great to be here as well.
So, tell us first about Investorist. What do you do? Let's set the context with your business first.
Sure. So we're the world's first global new build MLS. So what that means is we connect property developers and master brokers globally with the agents, advisors, wealth creation companies that sell their inventory. We have 10 offices in 5 different countries. We started in Australia, and we've got offices all around Australia. I'm currently in Miami, where our head office is for the USA. We're also in London and China and Southeast Asia.
And tell us a little bit about the business model of your business. Who's the customer? Who buys? Who pays? How do they pay? What do they pay?
Sure. So we have really, I suppose, three customers. We've got the sell side of our marketplace, and that is property developers and master brokers. And when I say master brokers, in the USA, some of our key customers are people like Douglas Elliman, Corcoran Sunshine, Savera Real Estate Group, and then I look at developers like Related, Trump Group, here in the States are customers of ours. And then on the other side of our marketplace is our demand side. Demand side is typically, they may be realtors, or they may be migration agents, they might be wealth creation companies, and they tend to be interstate or international. So we've got about 800 companies use our platform throughout China. We make our money, about 60% of our revenue is from our marketplace. So that is companies like Douglas Elliman, Savera, and Corcoran Sunshine listing their inventory on our marketplace to be purchased or found by brokers on the other side. And 40% of our revenue is a software as a service model, and that is companies around the world use our technology to run their own internal marketplaces and run their own internal sales. So we now have over 300 companies that use that software. One that's quite significant is Knight Frank. Knight Frank use our software to run all of their offices globally.
So you have both a private marketplace, which is a series of private marketplaces that are run on behalf of, white-labeled on behalf of major developers. And then you also have a public marketplace, which are developers, real estate developers, as well as the buyers of real estate and all the associated players in that ecosystem that are on a public marketplace model. Correct?
Yeah, that's almost correct. So all of our marketplaces are closed because they're business to business, not business to consumer. So everyone that accesses our marketplace is a property professional, pays us a fee, and is able to log in through our infrastructure. But we also, yes, have these private marketplaces, these white label portals. But the significant part of our private marketplaces is that they do connect with each other. Very much like a Google spreadsheet. A Google Drive spreadsheet allows you to share documents with each other. Our platform allows project marketers, master brokers to co-broke on property development projects, which is very significant.
And the way you make money, of course, in the white label case, it's a software as a service business model. In the B2B marketplace, public marketplace, what is the model? Is it commissions on the properties that are bought and sold?
No, we don't take any commission, which is unfortunate because we have more than $50 billion US worth of inventory on our system that's transacted through there at the moment. But we charge based on listing fees, and we also have a membership fee. So we have monthly fees to have your project live in our marketplace, and we have monthly fees to allow you to access that marketplace.
All right.
And we have more than 6,500 different companies subscribing to that service. So we're a low-cost, high-volume solution.
Got it. All right. So I know you have a very interesting beginning story, and we, our work and our audience is very largely very early stage entrepreneurs. So I'd like you to tell us a bit about how you started and how you got your business going, how you built your business.
Yes. So I own an advertising agency. I worked for a large property developer in Australia. I then started my own. I was a terrible, terrible employee. And then I started my own advertising agency. In that advertising agency, we built lots of small websites for property developers taking their projects to market. Those microsites had a glorified Excel spreadsheet on the back end of them that allowed the developers to manage their inventory. Then I started building more sophisticated versions of that, and I came up with the idea of Investorist. I think, Shramana, the part of my story last time that you particularly liked was my naivety as an entrepreneur, where I thought I would be able to build a really great piece of technology, and so I spent more than $1.5 million building a really great piece of technology and just expected people to use it, which they of course didn't. And so I bootstrapped that myself, and then I bootstrapped my first 45 clients before I realized very, very quickly that if I didn't get some equity and some other investment, it would be a very short journey for me as an entrepreneur.
So talk a little bit about that bootstrapping period. Did you keep the advertising agency going at that point, and you were subsidizing the development of this technology?
Yeah, absolutely. I actually still have my advertising agency going now, but thankfully it doesn't subsidize the business anymore. But at the time it was. So I had at that time 24 people in my advertising agency plus 12 in the tech company that I bought. So 35, 36 odd employees. And it was quite a profitable advertising agency. It was good.
Obviously.
Every single cent that I made went into Investorist. So then
you said you would subsidize also 45 customers, the first 45 customers. Talk about what those customers did and why did you have to subsidize them, and why do you call them customers if you had to subsidize them?
What do those customers do? Well, they didn't do anything because because I made the mistake of giving my software and my product away to them for free. So I went out and employed 2 salespeople and went around signing up customers, which weren't customers, they were just people that I knew in the industry, and basically gave them my software and gave them the ability to list, and expected that because I gave it to them for free and it was really, really good and I'd spent a lot of money on it, they would value it. And of course, they just didn't. I think that's rule 101 in building a tech company, isn't it? Don't just give it away for free and expect people to use it. People don't value what they don't pay for.
Yeah, and free users are not customers. There's a big terminology problem here, and that I want everybody to be aware of. And the story that Jon is telling is that he mistook free users as customers. Free users are not customers, they're free users, they're free riders mostly. So unless people are paying for the value you offer, you don't call them customers, they're free users. So what was the turning point? This, 45 free users that you thought were customers, and what flipped in your head that you did things differently when you reached the point where you had to go for the 46 free users?
Yeah, I guess survival flicked in my head, Sramana, and I realized that my free users, because it was free, they weren't even using it that much, and my 46th was just going to be going further into a black hole, and so I realized very, very quickly that I had to start charging. I was also very, very lucky. It was around that time that I got my first investor, which was Salter Capital, and they invested in the business, and their comments were, we really like what you're doing and we love the technology, but this has to change. And the first thing that has to change is people have to start paying. And we did that. So they invested and we started charging them. I actually started charging people before Salter Capital invested. But
so these 45 free users were open to paying for your product?
No, they certainly weren't. So those 45 free users, most of those didn't pay at the start. So it was basically the 46th user, they paid, and the 47th, and the 48th, and the 49th, and so
what
on
was
and so
the
forth.
difference in terms of the characteristics of the first 45 users versus the 46th, the 47th, and the 48th user? Did you go for a different segment, different type of user? What was different about what you went after to be able to get paying customers?
Absolutely nothing. Absolutely nothing. My product was exactly the same. My pitch was exactly the same. The customer I was talking to was exactly the same. The only thing that changed was that I gave my product value. So when you're giving something away for free, you're not necessarily giving your product value, but when you charge for it, then you're giving it inherent value. And it was that process of providing my product a value proposition that made all the difference.
And at this point, you were selling the SaaS product, the private marketplace offering?
At that time, I hadn't even thought of my SaaS product. I was only selling the marketplace offering.
I see. So these were membership. People were willing to pay memberships into the public marketplace.
Yeah, people were prepared to pay listing fees, and people were prepared to pay memberships.
Okay.
And I think one of the things about building a marketplace is it's very expensive to build a marketplace. If you're like me and you make that foolish mistake and spend all of your money on developing your software, then you'll end up with very, very good software and a very, very poor marketplace because you can't afford to build it. And I'd hoped at the time that because I was giving it away for free, that people would instantly use it. That is not true, and I don't know of many companies that have been able to achieve seeding their marketplace by approach. I think that what you need to do when you're building a marketplace is invest heavily, or what I ended up doing that got success in my marketplace is I invested heavily in salespeople and heavily in marketing in the regions that I was targeting. So I addressed initially my market of Melbourne, and I put a lot of money into acquiring the developers and the master brokers in Melbourne, Australia, that would be selling an inventory, and straight away I opened up markets, buy-side markets, demand markets in China and Southeast Asia, and with people that those developers and master brokers hadn't met before. So I instantly delivered them some value within weeks, and then the repeat listing started, and I started to get the first signs that there would be a sustainable marketplace business there.
So you tapped into the trend of Chinese and Southeast Asian buyers buying into the Australian property market, and these buyers were harder to reach for the Melbourne developers, and you kind of solved that problem of bringing them into this marketplace, and that was the draw for both sides of that marketplace to pay the membership fee for your portal.
Yeah, absolutely. Look, for the developer, yes, they don't know who these agents are, and they're very, very hard to meet, and they're very hard to find. But more so for my members, the agents on the other side of the world, they have language barriers. The property developers may come into the market once every 5 years, so long-term relationships are hard to build. And really, I guess the simplest parallel with my product and something else in the market is we're kind of like the Expedia for off-plan new build development. So you can go on there, find a particular unit and reserve that online, and that's something that was never in our market before. So it was a very, very simple proposition for the agents in China and Southeast Asia to sign on. And once that marketplace was seeded, it was a no-brainer for the property developers as well.
So, folks, those of you who are listening, pay attention to what we have discussed so far, and I'll call out precisely what I want you to underscore. In this story that Jon is telling, there was a lot of experimentation. He was a first-time entrepreneur. And the good news was that there was an advertising services company that was producing a lot of cash, which was subsidizing all these experiments, because there were a lot of mistakes early on, as Jon is telling you, that he spent too much money on technology development and not enough to seed the marketplace. So by the time he got to seeding the market, and then he gave a lot of stuff away for free, et cetera, none of which were great business moves. But eventually, once all this started to come together, and the cash that came out of the advertising agency services business was very helpful. So bootstrapping using services is a very, very effective and common way that a lot of entrepreneurs have mitigated this, early experimentation, early mistakes phase. And it's something that has worked for numerous entrepreneurs. So those of you who are looking for, strategic moves in terms of bootstrapping, service is one of the most obvious ways to go. Jon, you did something really interesting at this point, which is raise equity money from your customers. Tell us more about that. I love that.
So initially I thought I would raise money like everyone typically raises money from a VC or a bank or an investor in tech companies. And I thought that was the path that I should take, and that journey was horrible. I think people can read about that journey in your story, so I won't elaborate on it. But what did happen was, during a presentation with Salsa, they said to one of my salespeople, "Hey, you're looking for funds because I like this business." And And the salesperson said, yeah, we are, and put me in touch, and then they invested, and they invested because they really understood what we were doing, they understood what we were trying to achieve, and most importantly, they really understood the value. And we operate in a niche. It's a massive niche. So in Australia, the industry is worth $50 billion alone. In America, the industry is worth about $500 billion. So it's a massive niche, but it's still a niche, and it's something that people don't know about. So when I was talking to normal VCs, normal investors, they didn't get my domain, but my customers really got my domain and really got my value proposition. So we raised money from our customers round one, then we raised money from our customers round two. So seed was customers, and what was probably seed plus was customers again. And across that period, we raised about $4.5 million. We're now into what is probably considered an A round or maybe a B round. We're about halfway through that. We've raised close to $4 million now, again from our customers, and we're now out raising the last $4 to $5 million of that round. Sorry, the last $3 million of that round, and again from customers in Australia, China, and the USA.
Very interesting. So your equity investors are all customers, and they are deeply incentivized to promote your value proposition to the industry, so to speak. You have great advocates who are going out and talking about why they're using your product and how they're using your product and what value they're getting from it.
Well, I think that's true. It's interesting. My investors, whilst customers, they're not my biggest customers. So the majority of funds I've raised from customers. I've raised some funds from friends of customers, but that's quite limited. Most of it from customers. They're not my biggest customers, and so therefore I don't believe it drives much usage of my platform. Why it's been significant for me is that they really understand the need that my company solves, and that's why I've been successful raising funds from them.
They have domain expertise to understand why the customers want to use your product. Interesting.
Correct.
And you are at over $10 million a year in annual revenue at this point, right?
No. So we're at we will be $5 million in revenue this financial year.
Okay.
5.5. Yeah.
5.5. So now, $5.5 million in annual revenue. You're saying the overall property market is $50 billion in Australia, $500 billion in North America. What is that market, from a bottom-up point of view for you? Like, your market is not the overall property market. Your market is the number of property developers and buyers who are buying membership fees on your platform or are paying subscription revenues for your software as a service platform. So how big a company can you build out of this niche? What is your TAM, so to speak?
Yeah. This is another reason that the traditional VCs don't tend to like my company as much as I think they should, and that is because there is no data on the full potential market scale of my platform. So they tend to be a little bit more reserved.
You don't need data. This, the bottom-up TAM model is usually not data-driven. It's built on your business model and how many companies are out there. Like if you were to sell to 100% of your prospect list, how much revenue would you be delivering? That's the bottom-up total available market size, right?
It is, and the question is that there isn't any actual data on the number of participants that there are in the market. No actual accurate data because it's all out of date. It's not recorded with any government body in Australia, the US or the UK until it's complete, and then it's 18 to 24 months out of date. However, our conservative estimates that we've done internally are that in Australia, we currently believe we have about 9% of the viable market, and we've forecast that out over the next 3 to 4 years, as well as in the UK, where we believe the market is double Australia, and we've done the same in the US, where we believe it's 10 times. We believe we'll achieve hopefully 10% penetration in the US, hopefully 15% penetration in the UK, and up to 30% in Australia over the next 5 years, and that will make us about a $50 million revenue company at that point.
Great. And it sounds like there is a particular trend that you are keyed into, which is these Chinese and Southeast Asian property buyers who are buying in Australia, who are buying in North America, who are buying in UK. That trend is not just a China to Australia trend, it's a China to United States trend, it's a China to UK trend, and I think that tailwind is in your favor, yeah?
Yeah, it's actually not even just a China trend. It's China, so our largest growth market for demand is Asia. Our second largest is the Middle East, and our third largest is Latin America. And the things those markets have in common is that they are wealthy markets, but they are politically and economically unstable. And so the trend that we see is funds flowing from politically and economically unstable economies and countries into ones that have stable economies, stable governments, and good education and lifestyle opportunities. So we capitalise on that trend by establishing ourselves in both the high demand sell side markets and the high demand buy side markets. And then we find that we not only have a good viable marketplace, but we're now starting to develop network effect, which is lovely, where our customers in say, for example, the Middle East are pushing us into new sell side markets, and new sell side markets that we open up pull us into new buy side markets, like America is pushing us into Latin America. It's no coincidence that we opened in Miami, Florida as our head office. We could have chosen, like any tech company, Silicon Valley, but we chose Miami, Florida, and that's because it's the gateway to South America.
South America, yeah. Now, if you were to look at the timeline of what you have built so far, and let's say your journey to become a $50 million a year company, what is the length of that timeline? How long from 0 to 50 million?
So we've been live for 3 years. We have been commercial so we've been charging our customers for just over 2 years.
Okay.
So I suppose you'd say it would be a 5 to 6 year journey from 0 to 50.
Okay. So, this is a question that I got recently. I've been doing this video blog on LinkedIn. LinkedIn has just released a new product, a video blogging product, and they've only offered it to the influencers, and I have access to that product, so I've been using it. And I talked about this issue that you are raising, is that your company, the kind of company you're building, is not attractive to VCs because it's, 0 to 50 million in 5 or 6 years, whereas VCs are looking to go from 0 to 100 million in 5 years and things like that. And there's a growth rate issue, there's a total available market size issue, and you also explained your analysis of the market size and so forth, and that's something the VCs are not entirely comfortable with, can this be a billion-dollar company, etc. And my take on all that is that what is wrong with this picture? I love the fact that you're very steadily executing. You're already going to be at 5.5 million this year. you're growing steadily, your network effect is starting to kick in, you have a good handle on your customers are investing in the company, and you're going to have a very solid, multi-tens of millions of dollars of business in the next 5 years. What if it takes 7 years? Even that is fine. What is wrong with that picture? And somebody, so I did a video blog piece on this, and somebody asked the question, so $0 to $10 million in what time frame? And my answer to that was, in whatever time frame it takes. Who cares? Your investors would care, but if you don't have investors, one, nobody cares. But if you do have investors, people do want return on investment in a certain time frame. But if you, in a lot of cases, entrepreneurs are building businesses that are not VC fundable, and they'll have to bootstrap. And in which case, if you do not have investors, you can take as long as you want, and who cares? In your case, though, you do have investors, and your customers are shareholders. So what is your game plan in giving them returns? So is this going to be an exit play? Is it going to be some sort of a pub IPO in the Australian market or some other market? Or is this going to be an acquisition? Or are you going to give dividends to your customers?
Yeah, that's the number one question you get asked on a capital raising journey.
Of course.
We don't believe this is a dividend play. That said, we will break even within about 12 to 18 months, and then the company does start to make quite good profits. We believe this is an IPO play in the Australian market. However, we are also very cognizant of the fact that companies like mine, prop tech companies, are widely acquired by the large B2C portals, and we're in 3 markets with the most dominant B2C portal players that are very hungry for acquisitions. So personally, I'd love to take this company to an IPO, and that's what I'm planning in the next 3 years. We've put the processes in place to be able to achieve that. But I've also committed to my investors that I will not hold on to that dream too fervently if the right opportunity comes our way.
Yeah. And in the Australian market, the threshold, the size threshold, the scale threshold where you can go public is a lot smaller than in NASDAQ or New York Stock Exchange. So you can take a $30, $50 million company public, and that would be fine too, is what you're saying.
So, Romana, companies of my scale are going public on the Australian Stock Exchange. So companies at the $5 million mark or less are going public. I personally think that's a mistake. Yes. I think that that ties them up with a whole lot of compliance and a whole lot of red tape that slows down your growth. And I believe at this stage of a company, what you need to be is nimble. You need to be able to make decisions with a small board, and you need to be able to grow. And I think having the financial and regulatory pressures of a stock exchange at this juncture is a mistake.
And your investors have only been in the company for a couple of years, right? You've had investors in the company only for 2 years so far.
2 years. Yeah, 2 years. That's correct.
So you have plenty of runway. You can easily go 5, 6 years. Let's say 2 years you've already gone. You can go another 4 or 5 years with these investors without them needing an exit or liquidity right away, as long as their return on investment is solid. So you have lots of runway even from an investor schedule point of view.
Yes, we do. We do.
Well, it's really awesome to see your completely different strategy of navigating your company. I'm thrilled that it's working, and I wanted to present this to our audience, and I'm sure a lot more people will be learning about it through listening to the recordings as well. So thank you for coming, Jon. It was a real pleasure.
Pleasure. Thank you so much, Romana. Thank you for having me.
You're very welcome. Folks, we're going to switch to the mentoring portion of the session today. Let me set a little bit of expectations here. this is a very safe working session. This is not Shark Tank. We are here to work together and hopefully help you address the issues, strategic issues that you're dealing with. So feel free to be and to feel completely safe. We're not here to needle you and to embarrass you and all that. This is about helping you make progress. Remember, we've talked about this earlier in this session with John and also in general through the program. The message that I want you to take home is not all businesses can raise money. At least not all businesses can raise venture capital money. And raising VC money doesn't guarantee success. Not all businesses should raise VC money either, because there are certain particulars about venture capital that you have to take into account. So keeping that in mind, please be more open about how to build your business, focus on customers, focus on revenues, focus on profits, and those are the fundamentals of building businesses. The financing strategy is a tool that you need to figure out what is the right way to deploy that tool, but that is not the end game. And also, this is a roundtable. We want you to participate, so please do participate in public chat, and also I'll open up the line so that you can participate by asking questions. We're going to start today's session with Joseph George. Joseph, if you could unmute your line, tell us what you're working on with Tiger Digitech.
Can you hear me?
Yes.
Hello. Okay, hi, Mr. Smyrna.
Go ahead.
Am I audible?
Tell us what you're working on.
Hello, am I audible?
Yes, we can hear you.
Okay, hi again. So I'm based in Mumbai, run a company called Tiger Digitech, and there's too many similarities with what John just shared. Okay, so we started as a bootstrapped company. The journey has been almost a little over 4 years. So we had a services company called Sunday Mobility. We developed end-to-end mobile solutions for all sorts of clients, some very premium clients as well as small ones. We kind of did that for a year or two, and then we got into real estate tech. So we run a few sort of products. So there's a MLS kind of product for real estate brokers in India. We have some 30,000 plus brokers using that. We got some 150 odd developers who use our enterprise suite which we made for them. So these are all end-to-end solutions. It's got CRM, it's got mobile apps, it's got a whole lot of stuff, right?
Yes.
So the last 2 years, a lot of learnings in both these businesses. We kind of use that to build what is Tiger Digitech now. And our core product is called Tiger.do. So I'll just tell you about Tiger.do in a bit. We are a 30-member team, okay, and most of the team members have been around for over 3 years. So it's a very stable team with very tech culture. Now, Tiger.do is essentially targeted at micro businesses. Okay, so what are micro businesses? Essentially, these are organizations with less than 10 employees. 95% of firms globally fall into this category. So if you look at the US numbers, that's 26 million out of 27 million businesses. 22 million firms have no formal employees. So that's the segment we are targeting. And then globally, that number is around 150 million businesses, right? But these don't include, so these are all figures from government sites and where the registered businesses have been put up. They don't include people who are probably not registered and doing businesses on the site. So go to the next slide, please. Yeah. So the whole issue with micro businesses is they get clubbed with SMEs, okay, and that's the two are completely different animals. For one, the micro business owner is the business, right? He personally drives it. He wears multiple hats. So he's probably the accountant, he's the IT guy, he's the sales person, he's the marketing person, and so on. Not necessarily always desk bound, probably not aware of a lot of tools like CRM, ERP, and so on. Team may not essentially be of managerial standards. So whatever normally pitched out there saying these are enterprise solutions or solutions, they're not consumable. So if you want to think of this micro business, say a lawyer, a dentist, a florist, a wedding planner, so just think of what the solution he or she should use which lets them leverage technology for their business, right? And try to list down everything that's there, right from being able to create a website on their own or analytics for the website or a CRM, you end up with some 10, 15 different apps or solutions one has to handle. And that's fundamentally where the problem starts, because one, it's too much to handle for one person. Second, each of them would have a very low frequency of usage, so they get forgotten. So if I use something for a purpose and I use it only once a month, very unlikely next month I'm going to remember to use that. A lot of these solutions are also made very deep, so probably it's only 20% that's usable, but they go all the way to 100%. So again, the complexity comes in. So they're very specialized solutions, but I don't need 80% of it. It's like Excel. Most people don't use more than 5 or 10% of what Excel offers. So everyone wants to be tech-enabled, a lot of buzzwords around technology, but how do I use it, right? So that's the problem we're addressing. Is it the next slide, please? Yeah, so if you're articulated it, I need an easy, comprehensible, and usable way to leverage technology for my business. And that's what Tiger delivers. It's a complete solution in an app. So we just split it into 3 segments. We're addressing them in phases. Phase 1 is the segment which has a website. It wants a better website ROI. They have no digital agency. They may have no live chat and so on. Phase 2 is people who have no website or an app. They probably don't even have an official email. And phase 3 is people who kind of study both these segments, but they want better solutions which can be easily used. So we've rolled out phase 1, and it's designed to seamlessly evolve into phase 2 and phase 3. Yep. So this phase 1 is an end-to-end website digital management app. So it's on a very, very simplistic level. It gives you an alert the moment somebody lands on your website. You can do live chat. You can add multiple websites. It's got a very, very comprehensive website analytics built into it. And it's got leads, record management, share videos, and so on. So that's what Tiger does right now. It's been rolled out. We did a soft launch. Go to the next slide, please. So these are things we've kind of done. So we've got on 60, 70 odd users. We've tested it out at multiple price points. So far, it was all direct sales. So me or somebody from the team would approach people, pitch it to them. So we've had pretty decent conversion rates in 2 segments. So one segment where we sold it at $750 for an annual license, and the other one at $99 for the annual license. So fantastic usage. We've tracked them over 3 months. The whole acquisition process is fairly simple. It was never payment on the spot. It was they use the trial period and they call back if they like it. 90% of people call back and said we want to pay and continue using it. Even usage post 90 days is really good. Very, very active on it. So now what we're doing is transiting from the direct sales model, which is a very face-to-face kind of sales model, to a digital acquisition model.
So hold on, that's where my main question is. The whole time that you've been speaking, Joseph, that's the question that is ringing in my head is, what is the customer acquisition strategy?
That's right. So we'll come to the next slide, if I may just, So we've basically got 3 elements here for customer acquisition strategy, but the core thing is the way the product has been designed. So it's not designed to have a very, very engaging implementation cycle. It's fairly simple. For example, the way it is right now, you download the app and all you do is enter your web developer's email ID, right? And from then on, there's an
So that's my question. My question is, how do people find you, and how do you find customers?
Okay, so what we're doing now, and this is what we've been kind of fine-tuning for the last 3 months, is an entirely digital acquisition strategy. So we've been able to figure out the targeting we need to reach out to business users. We have so it's broken up into 3 parts. There's a seeding stage where we get clicks and we get people to at least be identified as potential users. Then there's an entire content strategy which is exposing them to various facets of the product and use cases. And then finally comes to getting them to download the app, go into the trial period, and then pay for it. Okay, so
where are the leads coming from?
So it's on targeting basis, certain usage, user descriptions on AdWords and on Facebook.
Okay, so you're using Facebook ads and AdWords to get to these businesses, is what you're saying.
That's right. So if I may put it in a very simple way, one of the groups we target is people who are looking for business software. Okay, so that's a targeting option in Google. Okay. Similarly, there's another targeting option which is people are looking for business finance, right? And these are like just the group which is people looking for business software. That's almost like 1 billion plus impressions, between India and US, right? So it's a huge segment out there which is reachable through this.
Okay, and that is converting for you.
Pardon?
That is converting for you.
That's converting. So there's a bit of a change we're doing now. So just so that the payment cycles become a little better, right? So there's some learning in that, which is what we're implementing right now. Okay, and so that is one. So just go back to the previous slide, please. Yeah. So that's the digital acquisition strategy. So we have a push strategy, which is what I just explained. There is also a pull strategy, which is what we will be deploying now with phase 2, because so pull basically is people who are already searching for stuff, so it's more search and keyword oriented. There's a reseller program which we've just rolled out a pilot. It's through an app. Anybody can sell it for us and earn a commission. There are certain direct marketing companies which we are approaching. So there's one which is the largest in the world. We are in discussions there. And there are alliances. So these are with payment gateways and banks. So that discussion is also on. But these are all in India.
I don't like the reseller strategy that much because the price point is so low. To incentivize people to actually work on your behalf is not going to be easy.
I understand that. So that works in India. If you go out of India, we'll have to think about it.
Yeah. So are you right now focusing only on India?
No. So we find so all this the reseller thing is all in India. We've got users both in India and US. So we're not focused only on India now. So we've rolled out US some time ago. So we've got some feedback there on the price points and all. After we've got we have to relook at the pricing and increase it. So that's what we're not just on India right now. So we're looking at a completely digital model of acquisition. The reseller model is largely designed for India.
But even if you look at a digital model of acquisition, you do targeting when you use Facebook ads or Google AdWords. You do targeting. My question is, where is the targeting and this validation? 24 customers at $750, 22 customers at $99. What geography are we talking about?
Those are all India. Those are all India.
All India, okay. I see.
That's in India. That's right. So what we really tried out there was, one is of course the whole process of onboarding, whether they're able to understand all aspects of the product, where they're using it, are they able to keep, do they continue using it over a period of time? So we've already kind of got all the learnings in and fine-tuned the product, to be far more usable. So
do you have an understanding of the unit economics of what are you spending to acquire what customers?
That's right.
You're talking about funding, right? If you put in, let's say, $1 million, how much revenue are you going to be generating?
So I'll just explain the acquisition cycle and the way we're looking at it, right? So what we are right now running at is almost on. Okay, so I'll talk Indian rupees because those numbers are right there. We almost at around 4,500 to 5,000 rupees per paying customer right now. Okay, we're charging in Indian parlance around 6,700 rupees for the license. So we are within the price point, so we're not burning or per acquisition. However, what we need to do is bring that down to 3,000. So we want to be operating at around 40 to 50% of the license cost as an acquisition cost.
So that is, the kind of business that you're trying to do. This is going to be a requirement. You're going to need to understand the unit economics of customer acquisition, because the whole game in this business is going to be customer acquisition.
Absolutely.
Can you acquire customers profitably? Can you scale? Can you acquire customers profitably? Can you acquire customers fast? What is the sales cycle? How long does it take you to close these leads, etc.? Those are the questions that investors will want to see evidence of, and if you can answer those questions, then you can fund this company.
Absolutely. So those are things which we have I would say, a broad understanding now, and we know the boundaries we are operating within. So typically, to get a paying customer right now, it's around 30 to 40 days. Okay, and the whole collection cycle is pretty immediate because it's all online or through the Google or the Apple payment. So that's not an issue either. So right now, from the point we seed or we kind of identify a prospect digitally, engage him with the content and get him to get into the trial period is roughly around 20 to 25 days. So we had learning on the trial period and the way we should be operating the trial period. We believe in another 20 to 30 days we should be able to convert that into a paying customer. So that's what so the product is ready for almost 6 or 7 months. We've been fine-tuning all these things because we understand that's where the real, the juice in this whole thing is. So if we can hit those cycles, it's an extremely viable business. And the key in this also is the way we up the value with every phase of the product. So right now the product we have in phase 1, if we reach out to 100 people, we believe there will be 1 or 2 who will, and I'm talking the digital parlance, who may show interest. By the time phase 2 comes in, we believe that 1 or 2 out of 100 should go up to a 5 out of 100. So that brings a lot of efficiencies in what happens downstream in the acquisition process. Okay, so that's the other reason we've been pushing the phases rather than wait for one phase to kind of be milked and then go on to the next one.
All right, Joseph, we understand the business. You have something interesting going here. You have to put together a proper investor presentation. This is not an investor presentation, but I understand what you're doing. I don't agree with your comment that you believe the US ecosystem is better to tap necessarily. It's also very crowded. You run into all these GoDaddies and Shopifys and all these players who are micro business website platforms. That's not necessarily the competition that you want to go into. So I don't buy completely into your US ecosystem comment, but I'm willing to listen, and we need to look at data to see what is the competitive landscape and what is the right positioning and what is the right strategy based on which you raise money. Because you raise strategy on the basis of, you raise money on the basis of a strategy. You don't raise money on all possibilities. You're going to have to put together a strategic plan, and that investors would either buy into that plan or not and give you facts. Give you feedback, and you have to go from there.
Sure.
So, in any case, it's very interesting, and we can look at it more. Right now, I'm going to move to Tarun's presentation. Why don't you hang on and listen to the segment where I'll explain how to work with 1M1M. If you choose to work with 1M1M, I'll be happy to help you further with this.
Great. Thanks, Tarun. Thanks.
Very welcome. Tarun, you're up next.
Okay, great. Can you hear me?
Yes, we can hear you fine.
Okay. My slides are not as colorful. I deliberately used your template, but anyway, we'll just go through it. So yeah, I'm Tarun Sukhani, and I'm based in KL, Malaysia. And I deliberately chose that picture because that was the picture taken in Sri Lanka when I was doing pretending to be an elephant mahout. So, but yeah, and that's quite relevant actually to what we're trying to do because we're in the currency exchange business, so travel industry basically. So our company is actually a sharing economy company, but our first application is called Frexi, which is an on-demand currency exchange, basically the Uber of money services. So yeah, next slide. And you can see our kind of landing page at frexiapp.com. So basically, it's quite simple. Our initial target market, the pain and problem that we're trying to solve is for international travel, especially if you're talking about multi-currency or multi-country travel. So this is especially painful when you're talking about traveling in countries, in regions like Southeast Asia or South America, where you have a slew of different currencies available, like maybe over a dozen, all within a 4-hour travel time span, over an airline. So if for example, you take a look at where I am, you've got, Singaporean dollar, you've got the Thai baht, Philippine peso, the Indian rupee, and the list goes on, Vietnamese dong, and so on and so forth. And then, so Hong Kong dollar, I'm not going to go into all that, but basically there's quite a few currencies. And of course, that means that there's a lot of opportunity for ripping people off as well. So, one of the things that I noticed is that when I was traveling from country to country, I normally didn't have time to exchange at the money, changer, because I was doing a lot of training and consulting. And so I always found myself stuck at the airport, either leaving or arriving, and having to exchange currency. And of course, everyone knows that at airports, they're going to charge you up to maybe, 20 to 30% more than you'd find outside on the street. So that really became a hassle. And even if you're, well-traveled and well-heeled, and you have, let's say, for example, an ATM card or your credit card or whatever, and you can withdraw cash, you're still paying, pretty exorbitant foreign exchange fees. And then there may be fees on top of that as well, withdrawal fees. So we wanted to my partner and I wanted to come up with a better solution. And so we decided, why not do something like a semi-professional mobile money changer service for money exchange. And so that's how the idea was born. So basically the target market is international travelers initially, and we're looking basically to solve the problem of getting, rid of, not getting rid of, but sidestepping money changers and banks to do money exchange, to avoid a lot of the, the costs associated with that, to avoid, the spreads, the bid and ask spreads, basically, the high bid and ask spreads. And also, we also have to take a look at availability, which is a problem that a lot of people don't talk about, which is, for example, let's say that you're in Malaysia. You're not going to get Colombian pesos, for example, and actually, I had to travel to Colombia, believe it or not, from Malaysia. So, and then another thing is, for example, coinage. So, for example, Singapore has, dollar coins. So, and if you go to Malaysia or any other country, they won't accept coins. So you're basically stuck with dollar coins, Singapore dollar coins in your purse or wallet. Yeah. And then, of course, there's the convenience factor, because obviously you don't want to stand in line and things like that and have to worry about currency while you're at the airport, especially for someone like me who's always late to flights. It's really not, it's a hassle. So basically, Frexi eliminates that need for fixed middlemen, replaces them with mobile money changers that can exchange for cash or digital money at the press of a button. So costs are vastly reduced since there's no overhead of maintaining an external premises or hiring managerial staff. So these are like independent agents, like Uber's independent taxi drivers. Next slide. Okay, so in terms of customer acquisition, well, let me just talk about the completion. So we have to complete our MVP, which we're almost done with the mobile app. The back end is done, more or less. And so we were working, quite a few months on the back end, and now we're trying to finish up the front end.
I'm thinking through what you are proposing here, Tarun, and the back end actually sounds quite complicated to me. It's not a question of the app, it's a question of how do you deliver so many different currencies to people if you're trying to actually cover multiple currencies. If you're trying to cover just Malaysian money in Malaysia or Singaporean money in Singapore or Colombian money in Colombia, that's different. That's actually relatively straightforward. You have delivery people who basically bring the currency in cash to the people who are using your product, and that's that. Are you actually proposing that you're going to be able to do multiple different kinds of currency exchange in one place?
Yeah. So it's basically just like the Uber model, right? So we basically we want to become the world's largest currency exchange platform without holding physical currency ourselves. And the way we do that is our customer acquisition strategy is starting off as we're going to wait at airports. We're going to take our ringgit, right, and we're going to acquire foreign currencies. So people will exchange, for example, British pounds or Thai baht or whatever for ringgit because they're coming into Malaysia. So as they're transiting into Malaysia, we will acquire these currencies by exchanging ringgit with them. So now we're going to build up an inventory of these foreign currencies and then use that for further trading. of course,
yeah, but you have to
take into
move
account
that currency around. It's still physical currency. You have to move that currency around. Currency doesn't move around just like that. If you're trying to do this on a global basis, you can't move that currency around physically.
Right. So there's two, of course, different markets here. One is the physical cash market. The other one is the digital, currency market. So if we digitize that currency into a foreign currency wallet, then those exchanges become quite seamless. Then it's just a matter of exchanging with people who have that available currency in their wallet, in the digital wallet.
Is that your proposition? Is that the value proposition, that you're going to convert physical to digital currency?
Wallet. Yeah, multi-currency wallet. So if you look at the current solutions, they limit you in terms of the number of currencies, and of course there's still costs, associated with that. So what we want is a truly multi-currency global, marketplace, so that you can trade your currencies, your excess currencies, for any other currencies you need. And in effect, you can actually even become a mobile, currency trader. But that's a different thing for the future. Actually, we have two different customer acquisition models. One is for international travelers, and another one is for traders themselves. But I didn't want to get into that at this point. But yeah. Can we go back to the previous slide just to make sure that I didn't miss anything? So in terms of customer acquisition, we want to actually stay at airports. We're going to hire a bunch of college students, to put up the banners and everything, and actually do the exchanges. And that's basically how it's going to move. And then in the future, when we digitize the currency, then it becomes like Uber. Say, okay, I need this currency. So you'll see the agents around you, and then they can meet you and then give you that currency, if it's physical. If it's just digital, then they just exchange it with you automatically. Yeah, next slide. Okay, so we did do AYTM in the very beginning, just to see what kind of, just to get a survey going with it, to see what kind of demand there would be for for a service like this. So 80% of the respondents were quite interested and keen in something like this. And then, of course, we did some other validations where I actually went with foreign currency into a bunch of 7-Elevens, and I tried to exchange it like that way, and just ask people, hey, what's stopping you from just exchanging with another person? And they said, well, it's a trust factor, obviously. We don't know if we're getting counterfeit or whatever. And I said, what if that person was KYC'd? In other words, that person was a semi-professional, that person could be vouched for. Then would you trade with that person? I said, yeah, of course, then it's not an issue. It's just basically taking the teller outside of the money changing office and just meeting him on the street. It's the same thing. We still trust him. And that happens every day, believe it or not. They're called hawala. So actually, our model is legitimizing the hawala business. We want to create an e-hawala model and bring out these people from the black market.
Okay.
So if you take a look at the multi-currency travel market, the largest markets are in South America and Asia. So, and as I mentioned before, because there's so many different regional currencies. And if you take a look at the travel market, so basically what we're trying to do is parlay the travel market into this currency exchange market. But really, there's two models. What we really want to create, our vision, is to create the world's largest consumer Forex market. Because everyone would have these currencies, right, in their digital wallets or in physical cash, and they'd be able to trade it. So that's, in fact, a consumer Forex market. And it would
the part that doesn't jive with me, Tarun, is you're saying currency exchange in this part of the world remains a vibrant market because cash is king. Well, if you're assuming that people are okay with transforming physical cash into digital cash, but if people cannot pay in digital cash, how does that work?
Okay. So in certain markets in the developing countries in Southeast Asia, for example, like these specific developing countries, in those markets, cash is king. And so obviously, the ability to get currency at good rates is really critical because that's where you get screwed, right?
Yeah,
so
but you're not going to be able to do that, right? You're saying that your model is to convert physical currency into digital local currency.
No. So what we're doing is, okay, so for example, if you want cash, right, then our mobile teller would come to you and says, okay, so give me 400 ringgits in cash, and I'm going to give you 100 Singapore dollars in cash, right? So that's one option. The other option is, no, I have 400 ringgits in ringgits in my digital wallet, and I want to get Singapore dollars in exchange. So that's a purely digital transaction, and you would be deducted from that wallet, and magically you would see, whatever 100 Singapore dollars appear in your wallet.
So you will provide the local currency in cash to the travelers, but when they change it back to their original currency, you will give them that back in digital, not local.
It doesn't make a difference what the currency is. It doesn't make a difference what the currency is. What matters is supply demand. So if any of our
No, the operations matter hugely. You're going to have reserves of all sorts of currencies to be able to seamlessly flow. Otherwise, you can say that, oh, I don't have British pounds, so I can't give you British pounds. That's not going to, if your value proposition is that you can get any currency you want in cash or in digital, that's operationally a very complex thing to run.
Right. So we have to work our way up to that. So that's going to take time. But initially, obviously, we're going to focus on, the critical currencies that are being traded within that country. And so that's what we're going to focus on. But yeah, in terms of acquisition, yes, there's definitely going to be a cost associated with growing to that level. But if you basically realize that it's just a bunch of people trading, right, eventually you're building up that currency inventory over time as more and more people start using the platform. And it's a more accurate reflection of what's actually the demand in the market.
We're going to need to move on. I'm going to answer your questions and move on to the next segment. The thing that worries me about thinking about scaling this before actually proving out the concept and working out the details of the concept in one place in a small, manageable format is that that's not how businesses are built. So the question is, can this business become a substantially revenue-generating business if you were to just do it in Malaysia? Or if you were to just do it in Kuala Lumpur? In some small format, can you turn this into a revenue-generating business? Or is this the kind of business where you need to put in a huge amount of investment to get anywhere? And if that is the case, then I would say you're trying to do this from Malaysia is going to be very difficult to manage. Because raising that level of money, there are very few places where you can raise that level of money to do something that is very, large capital-intensive project. And especially in financial technologies, as you point out in your second question, is the regulatory issues. Frankly, I have no idea what regulatory obstacles you will face. I know that you will be facing tremendous regulatory obstacles. So how you're going to get past all that, I don't know the questions to any of these. And I know that in Malaysia, this is going to be incredibly difficult to finance. So if your business is predicated on raising huge amounts of financing and getting past huge regulatory obstacles, I would advise you not to do this business.
Okay.
Because the risks are so high.
Did you want me to answer these questions, or did you want me to just keep this in mind?
No, I'm answering those questions for you.
Okay. But because we already have answers to these questions.
You have answers to these questions?
Yeah.
Okay.
So in terms of scaling, we're going to start off actually in Malaysia. Both Singapore and Malaysia actually Singapore has already started it. The MAS, the Monetary Authority of Singapore, has already created a sandbox to support initiatives just like this. And Malaysia has just released a consultative paper, and in Q4 of this year, they're going to also have their regulatory sandbox, which we're already applying for. So that allows us to do something like this. There's a company that came out of France called Wheelio, that wanted to do something like this, but it was peer-to-peer. So ours is more of a Uber model where it's semi-professional.
So if you were to, let's say the regulatory obstacles are manageable, can you turn this into a revenue-generating business without raising huge amounts of external financing?
Yes. So the way we would do it is we would start off with just ringgit, and we would start exchanging that for other currencies, right? We'll build up an inventory, right, of these other currencies, right? And remember, we're getting the exchange not just from them coming in, but also leaving Malaysia. So once they're leaving Malaysia, we sell them back the British pounds and get back ringgit. So this is, you know, a feedback loop that, you know, virtuous feedback loop that where you're claiming that ringgit back at some point. So the idea basically is that as people are transiting in and transiting out, right, you're constantly building up inventory. And yeah, we do want to start off at airports, but
so by the way, I'm not concerned only about inventory. I'm concerned about revenues.
Okay.
Remember,
So
the question I asked you is how soon can you turn this into a revenue-generating business that can support your operation? Because
so in terms of monetization, the business model relies on the spread. So again, we make money the same way money changers do through a spread.
Sure.
But it works exactly like how Uber does. So it's actually based on supply-demand. So we actually decide what the pricing is, what the spreads are that the mobile money changers can charge. And so we are actually
Uber
making sure that
a huge amount of money on customer acquisition, and you will not have that money available to you to spend.
No, I'm just saying it's not obviously it's not like Uber in that sense. What we're saying is that the inventory determines our supply-demand curve, which then determines pricing, right? But we want to make sure.
To get to that inventory, you're going to need to get people to use your service. So people need to learn about your existence and how are you going to acquire those customers. That's my question.
There will be an initial hit. Yeah, so there will be an initial hit in the beginning. The customer acquisition costs in the beginning will be high because exactly we want to keep the spread small, right, so that we can get more customers. But once we get more customers and build that inventory out, then obviously we can get spreads that are still cheaper than money changers or whatever. So it offers the cost advantage, but of course it offers the convenience advantage as well.
And then the obvious question is, how do you finance that customer acquisition cost?
Yeah, so we do have, so at this stage, basically, we do have, you know, family and friends round. So we do have pre-seed funding. And I guess we would say we're between pre-seed and seed stage at this point. So we basically are using that funding for finishing off the software, and then eventually, of course, using that for marketing and you know, buying some or just getting some ringgit, you know, just using the ringgits to acquire foreign currency. But basically, we wanted to validate the model at airports and see if people are actually willing to exchange at better pricing, which we believe that they'll do.
Yeah, the part that concerns me is that these are very, very capital-intensive plays, and I'm just not convinced that that capital-intensive businesses like this can be done out of Malaysia.
Yeah,
so
maybe. I don't know.
So well, what worries me is that you may, Tarun, let me speak. If you want feedback, you have to let me speak. Huh? What worries me is that you kind of get into this market with, you know, friends and family money and so forth, and then you can't really get past that, because if you're predicating your progress on raising money, that's the part that worries me. And which is why my question on how fast can you get into revenue and how fast will that start generating enough revenue such that you have a sustainable business. That's the question I would try to address and solve as soon as possible.
Well, I'm saying as opposed to what I think John was it, we're not going to spend $1 million up front and charge customers $0. We're actually charging them the spread up front. So we're actually making money up front.
The question is, how much are you going to be making, and will that cover your operating expenses such that, and customer acquisition costs to grow for a substantial period such that you can reach some level of critical mass? That's the question.
Yeah, so we believe that, you know, just like with any other money changer market, because actually my background is in BFSI, and I was a CTO of a money services company. So I'm well aware of, you know, what the initial costs are and the CapEx and OpEx with this model. Basically, what we're doing is we're digitizing and bringing an e-Hawala model, but it's no different than a regular money changer. So a money changer, of course, has, you know, large initial CapEx expenses, right? But once you have that inventory, then it just recycles itself.
Okay, well, you know what you're doing. Great. If you're absolutely convinced that this is going to scale and if you will be able to finance the scaling of it, I have nothing else to add to that. I'm just from somebody who looks at businesses all the time, I'm looking at the risks and I'm giving you my perspective on where I see the issues. And it's up to you to mitigate those risks.
Yeah, obviously there's risk.
No,
but that's the point of being
risk-free. It's a question of identifying what those risks are and mitigating those risks and figuring out strategies of how you're going to mitigate those risks. That's the point of these conversations. My point is not to tell you that your business is not going to work. My point is to analyze your business with you so that we identify what are the risk factors and, you know, plug them. The one thing that I don't want you to do is do a money changer business and assume that VCs are going to fund it. VCs don't fund money changers. You're telling me that money changers work out with by buying inventory and everything else flows from that to a, you know, I'm not in the money changer business, so I don't know this business, to a normal entrepreneurial questioning mind. My question is, how do you acquire customers and what is the cost of that customer acquisition? I don't need to know the answer. You need to know that answer.
Yeah. So we are calculating the cost, and yeah, we know there's going to be an initial hit. This model is definitely based
Tarun, good luck.
Yeah.
I hope you start validating this and start actually rolling into, you know, revenue zone as soon as possible. So absolutely, I think the point that Jon made very clearly is that you shouldn't be doing anything for free that doesn't have a clear monetization path, and that's obvious in your business. I don't think there's any need to do that because the business model doesn't even demand that you do that. So that's not even the question. The question is, how do you acquire profitably customers that will get you to a profitable, sustainable business? All right, folks, thank you, Tarun, for your presentation, and thank you, Joseph, for your presentation. We are going to spend a few minutes talking about how to use 1M, and then we can go back to questions if you like. Before we do that, request, if you like what we're doing here, bring serious entrepreneurs into 1M, and we are going to, this is the whole point of it, is to understand the risks of the business, understand the challenges of the business, and devise, you know, proper strategies on how to address those challenges in the business. Everything resources-wise is at 1m-by-1m.com. You will find a very rich, active blog, which is completely free. You can learn from that. There's a 12-volume Entrepreneur Journeys book series. You can learn from those books. These are case study-based books. You can also learn a lot from the website. There's a ton of material, videos, and all kinds of FAQs. These roundtables happen every week. You can come to any of the future roundtables. Just make sure you register to pitch or to attend. We have a premium program where we offer you extensive methodology guidance, a full acceleration program. We also have a self-assessment, which is kind of what I was doing right now with both George and Tarun, is ask questions, probing questions that get into the heart of your strategy, which is your risk mitigation strategy. So go through these questions, ask yourself these questions, and if you have knowledge gaps in terms of methodology, you could also use the 1M1M basic curriculum-only program, which is $100, which is a $99 a month subscription fee. The premium program is $1,000 a year. The basic is $99 a month. Either way is fine. You can start learning methodology, and do whatever fits your style of learning. There are many, many, many layers of offers here through which you can accelerate your learning process and put one foot before the other. Dig around on the website and see which program is right for you. There are tons of video FAQs. The program is case study based. We've had over 700 successful entrepreneurs, including 50+ unicorn companies, about 350, 400 venture funded companies, and another 300+ bootstrapped entrepreneurs and their successes, their journeys, their strategies. We've captured all that to help you learn from them and synthesized it in the video lectures and case study based curriculum. That's what you learn from primarily, and then you learn from the direct coaching, project coaching that we do in the roundtables. Our methodology is lean, capital efficient, bootstrap startups, because even if you raise funding, you're going to have to do that lean, capital efficient, bootstrap startup phase first and get yourself ready for funding, and that's just the way the market operates. That's it. That's all I want to tell you about the program. We have every Thursday, September, October, we have roundtables still, so please come and, share your thoughts, get feedback on whatever you need input on, and I'll be happy to work with you. That's pretty much all I want to share here. We can do a little bit of Q&A. Line is open. You have the instructions on your screen, and you can also use the public chat to ask questions if you like. Either way is fine. So feel free to ask questions at this point, and I'll be happy to answer. And if you have questions about the program, by the way, you can also contact Irina Patterson. Her email is irina@1mby1m.com. There is this myth in the startup ecosystem that you want to swing for the fences and take as much risk as possible. That is not how you win, actually. Savvy entrepreneurs mitigate risks. They identify the risks, and you have to be as open as possible in acknowledging what are the risks of your business. And then figure out strategies on how you're going to mitigate those risks, and you need to understand arithmetically, really precisely, what are your unit economics. So both in Joseph's business and in Tarun's business, my guidance to you would be to really precisely understand the unit economics of customer acquisition and the customer lifetime value of what you're getting revenue-wise from acquiring those customers. It's really, really important. Otherwise, you often end up with very unsustainable business ideas. And at this point, the market is correcting. So we've had some insanity in the market for a few years. Right now, it's not an insane market. It's a very sane market. It's a market that is in the correction mode. So people are not going to do brash things. They would want to see proper arithmetic. They would want to see mathematically sound business plans, customer acquisition strategies, unit economics, etc. So you're going to need to put all that on the table, especially if you're going out to raise money. And you absolutely have to have a clear handle on that if you're bootstrapping, because if you're bootstrapping, you can't really drain money. And Jon explained to you how he made these gigantic mistakes in his bootstrapping phase that sucked up a lot of his capital by giving things away for free, by investing a lot of money in technology and not enough on customer acquisition, marketplace seeding, etc. So these are things that you need to avoid, and you need to mitigate your risks so that you can get to a viable working formula as soon as possible without draining energy, draining runway. Maureen is providing a popular question from Quora. What types of startups are most popular in Silicon Valley? Well, you know, in Silicon Valley, things move in waves. So in the late 90s, it was the dot-com era. B2C e-commerce became very popular. In the mid-2000s, social media became very popular. In the late 2000s, it was all about cloud and mobile apps. In the early 2010s, it was big data. And right now, it's AI and deep learning and machine learning and applications related to those. So just some pointers. There are lots of variations on that. Folks, any questions? If not, we're going to wrap up the session, but you do have a few minutes to ask questions if you like. Also, this is a good time to introduce yourselves. If you haven't spoken already, you're welcome to introduce yourselves. Where are you dialing from? What is your project? What brought you here? How did you find out about us? All of those are reasonable introduction points. Joseph George is asking me what's the best way to follow up with you on this discussion. Joseph, at this point, if you want to work with me, you're going to have to join the program. So the only way I can work with you, you're going to have to basically join the 1M1M Premium program. And that's when I would be working with you on regular private roundtables and so forth. And by the way, in the curriculum, there is absolutely precise instructions on how to build your investor pitch and all the pieces that you need to learn to put together an investor pitch. I've tried to cover as much of that possible. So the combination of curriculum and private roundtable is a very powerful combination, and we have moved many, many entrepreneurs rapidly through the learning curve using that combination of online curriculum and private roundtable coaching. Anybody else? Any other questions? All right, folks, if no questions, then we will meet back here next week, same time, same place, and we'll continue. Hopefully some of you are going to pitch next time, and speak with you then. Bye-bye. Thank you very much for coming.